If I was starting to invest today, I would not change what I invested in. I would change how much I let fear decide. Years ago, with less than 5% of my net worth, I bought into 2 companies that everyone has heard of. Now, odds are, if you click this video, you are interested in learning about investing and potentially avoiding pitfalls, or you are currently investing and are considering ways to improve upon your financial knowledge. Either way, if I was starting to invest for the first time on my own, here is what I would tell myself, and here is what I would do differently. Markets move in cycles. There will be stretches that feel like the best of times and stretches that feel like the worst of times, often within the same 12 months. A strong long-term investment having a rough day does not mean that an investment is having a rough decade. Today's number and next decade's number are not the same conversation, even when they show up in the same account. Here's the reframe that changed how I look at the downturn. A decline in an investment is not a loss until the investment gets sold. The price sits lower than before. Nothing has been recognized yet. The same holds in reverse. A gain sitting in an account is not real money until the position gets sold either. Unrealized in both directions. Understanding that cuts the downturn down to size. A 20% drop on the screen and a 20% loss in real life are not the same event. Not unless a sale actually happens. If a plan is a long-term one, a swing in the market is not a crisis. A swing in the market is a plan working exactly as expected. When a stock or the market drops a few percent, buying more feels like buying on sale. In a sense, that is true. But moments like 2008 or 2020 do not come around as often as markets makes them feel. Waiting for the next big drop before investing again means waiting on an event that does not have a schedule. The better habit I would tell myself when starting out in investing: invest on a regular schedule. Market drop or not, take the discounts when the discounts show up, but do not make the discount the only reason that money goes to work for you. Here's a change in order, not only a change in amount. Start with saving 15% of your income first and build a budget around what remains, not the other way around. Saving whatever happens to be left over once spending already claimed a place at the table. What I've learned is spending expands to fill whatever room gets left over. Saving plays first never competes for that room at all. When I started investing, more than half of my account sat in cash. Not because the market looked wrong, because the money felt too hard earned to risk, and that fear had nothing to do with whether the investments underneath were any good. And I was waiting on the next 2008-2009 opportunity. That is timidity, not strategy. Few people in the same situation cannot tell the difference in a moment. Confidence looks different. Confidence takes a risk size so that losing the whole position still leaves the rest of the plan standing. Uncomfortable enough to feel real, but small enough to survive being wrong. Those 2 companies from the opening, less than 5% of my net worth between them. Losing the full amount would have stung and would not have moved the needle on my finances. But I felt strongly that both businesses would still exist in 20 years. And that a new competitor or existing one would have a hard time pulling customers away from either. Less than 5% of my net worth, the feeling at the time was closer to betting the whole thing. Years later, both positions have grown well past where they started, through price, dividends, and stock splits. The lesson is never which stocks to pick. The lesson is sizing a bet small enough to survive being wrong and confident enough to be worth making at all. None of this works without a foundation underneath. Before a single dollar goes into an investment, a few things already need to be true. Cash flow needs to be understood. Debts named and managed rather than ignored. An emergency fund needs to exist so that car repairs or a job loss never forces a sale at the worst possible time. And the risk being taken on needs to be a risk actually understood and accepted, and not a risk backed into by accident. Skip any of these and the confidence turns back into timidity, because every market drop now threatens money that should never have been at risk in the first place. Once the foundation holds, look for the companies with real staying power. 20 years from now, is the business still standing, still providing something people need or want? What would a new competitor or existing one actually need to do to take customers away? Real answers to those questions are worth more than a hot stock tip or a headline. Now, with that being said, what do you do next? Wait. Do not buy anything until the worst case has been set with honesty, including the version where the entire investment goes to zero. If the outcome is not doable for you, the purchase does not happen. No exceptions. Foundation in place and risk understood, and still serious about putting money to work An advice-only financial planner can walk you through what's best for your situation without a product sale at the end of the conversation. If I were starting to invest today, I would not change what I invested in. I would change how much I let fear decide, because wealth is not reserved and it's never too late to start. I'm Andre, and I'll see you in the next video.